The market is trading at all-time highs again. You know what happens next. Every single person with money on the sidelines is about to make the same fatal mistake they made in 2023, 2022, 2019, and every other year the market printed records. They are going to wait. They are going to tell themselves this is the top. They are going to sit in cash watching for the crash. And 6 months from now, they are going to be in the exact same spot, except the market will be 15% higher and they will be even more convinced they were right to wait. I need you to stop right now and actually hear what I'm about to tell you, because the data I am going to show you does not care about your feelings. It does not care that buying at peaks feels insane, and it is going to prove that the people who got rich in markets did the one thing that felt the most reckless at the time. Right now, while you are sitting here, hundreds of billions of dollars are being deployed into equities every year through index funds and pension rebalancing. Not because anyone thinks it is smart, because that is what the system does. Money keeps flowing in. If you are new here, welcome in. I show you the back-end mechanics that move markets while everyone else is staring at headlines. No hype, just data, patterns, and the structural forces that explain why your instincts are wrong. Subscribe, hit the like button, tap that bell, because what I'm about to walk you through will not show up on your news. You are about to see the study that proves buying at all-time highs beats almost every other strategy. The investor comparison that shows staying in cash for decades has historically been the worst wealth-building strategy in the study, and the exact mistake 90% of people make when the market looks expensive. Let's go. Here's what most people think. They think buying at all-time highs is idiotic. They think you're supposed to wait for crashes. They think the smart money sits in cash until everything collapses and then swoops in at the bottom. They think this because it sounds logical. Buy low, sell high, right? Wait for the dip. That is what every Reddit thread says. That is what your uncle says at Thanksgiving. That is what your own survival instincts are screaming at you right now. In reality, the data says the exact opposite. Let me show you what happens when you only buy at all-time highs. There's a study that tracked this from 1988 forward. 2 scenarios. Scenario 1, you invest on random days, any day, Tuesdays, Fridays, whenever. Scenario 2, you only invest on days when the market is printing a new record high. You only buy when the price has never been higher. Your gut says scenario 1 wins. Random days have to be safer than always buying the peak, right? Wrong. Look at what happens over time. In the short run, 3 months, 6 months, the results are nearly identical. Random days, all-time high days, basically the same. No edge either way. Your timing does not matter much when the window is that tight. But then you stretch the time frame. 1 year, 3 years, 5 years, 10 years. And here is where it gets strange. The portfolio that only bought at all-time highs starts pulling away. Not by a little, by a lot. The exact thing that feels the most reckless consistently generates better returns than playing it safe. How is that possible? Because the market regularly makes new all-time highs. That is not a bug. That is what long-term growth looks like. New highs are normal, not rare. If you refuse to buy unless prices are lower than they have ever been, you are sitting out during the majority of the actual uptrend. You are avoiding the very thing that creates wealth. The data is telling you that your instinct to wait is not protecting you, it is costing you. And there is a structural reason for this. The S&P 500 is a market cap weighted index. It automatically buys more of what is going up and less of what is going down through rebalancing. Companies that fail drop out. Companies that succeed grow larger. This creates a natural survival bias that pushes the index higher over time. On top of that, trillions of dollars flow into index funds and ETFs every single year through retirement accounts, institutional allocations, and systematic strategies. That capital does not wait for crashes. It deploys on schedule. Every 2 weeks when paychecks hit, money flows into 401k plans. Every month when pensions rebalance, money flows into equities. This is not hot money that panics and sells. This is structural flow that keeps buying regardless of price. That is why the market makes all-time highs so often. Because there is constant bid pressure from passive flows that do not care about valuations. Now here is where people push back. They say, fine, maybe buying at highs works on average, but what about right now? What about the risks we are facing today? AI valuations look insane. Geopolitical tensions are spiking. The national debt is spiraling. Inflation is stubborn. The yen had a violent deleveraging event just months ago. Gold is acting like something is broken deep in the system. Surely this time is different. Surely right now is the exception. Let me be very clear. Those risks are real. I'm not dismissing them. But there has never been a time in market history when there were not massive risks. Never. Go back to any year you want. 1999, dot-com mania and Y2K fears. 2008, the entire financial system was collapsing. 2011, European debt crisis and US debt downgrade. 2020, a global pandemic shut down the world economy. Every single year has headlines that justify panic. Every year has a reason not to invest. The difference between people who build wealth and people who stay broke is not that the wealthy ignore risk. It is that they do not let fear paralyze them into inaction. They understand that waiting for safety means waiting forever. Markets climb a wall of worry. If you wait until all the worry is gone, you have already missed the move. We need to talk about valuations because this is the other argument people make. They say it is not just price, it is what you're paying for. The valuation multiples are stretched. We are in nosebleed territory. And depending on how you measure it, that can be true or false. If you look at the Shiller CAPE, the cyclically adjusted PE that smooths 10 years of earnings, US stocks are at some of the highest valuation levels we have seen in decades, close to where things were in the dot-com era. But when you look specifically at mega-cap tech and adjust for their earnings growth, the picture gets more nuanced. Research from firms like Goldman Sachs suggests that the PEG ratios on the largest AI-driven names are closer to their recent cycle lows than to their 2021 to 2022 peaks. In plain English, they are expensive, but not obviously in the same bubble territory as profitless dot-com stocks were. Translation: you're paying a premium, but you're getting growth to justify it. The earnings are real. The cash flows are real. These are not speculative garbage companies with no revenue. We are not in dot-com 2.0, where firms with zero profits trade at 50 times sales. We are in an environment where the dominant players are printing money and reinvesting it into infrastructure that is reshaping entire industries. That does not mean it cannot correct. It absolutely can. But expensive and overvalued are not the same thing. Expensive just means the market has priced in future growth. Overvalued means that growth will never materialize. The evidence right now does not support the overvalued case for the mega caps. It supports the expensive case, which is a very different risk. But let's get tactical. Let's talk about what actually happens when you try to time this. I want to show you a study from Charles Schwab that tracked 5 different investors over decades. Each one used a different approach, and I want you to guess before I reveal the results which strategy performed best. Strategy 1, dollar cost averaging. You take the same amount of money and invest it every single month no matter what. Strategy 2, lump sum investing. You invest everything at the start of the year. Strategy 3, perfect timing. You wait for dips and you nail the bottom every single time. Strategy 4, terrible timing. You try to time it, but you fail miserably and buy at the worst possible moments. Strategy 5, cash. You stay on the sidelines waiting for the crash. Pause if you need to. Make your guesses. Ready? Dead last. The absolute worst performance was staying in cash. And this is critical because most people who stay in cash do not intend to. They think they are being smart. They think they are waiting for the right moment. They think they are playing defense. But what actually happens is the market runs for years, and every time they think about getting in, it feels too high. So they wait, and it goes higher, and they wait. And then finally a correction happens. 10%, 15%, 20%. And they still do not buy because they convince themselves it is not a real crash yet. They want 30%, 40%, 50%. They want blood in the streets. They want capitulation. They want the signal that never comes. And so the market recovers, and they are still sitting in cash. And now it is even higher than before, and they are even more convinced they were right to wait. And the cycle repeats. Look at what happened in March 2020. The market dropped 34% in 33 days, fastest crash into bear market territory in history. Unemployment spiked to 14.7%. The entire economy shut down. If you were waiting for blood in the streets, that was it. That was your moment. But here is what actually happened. Most people who were sitting in cash in February 2020 were still sitting in cash in April 2020. Because even at the bottom, it did not feel like the bottom. It felt like the beginning of a depression. It felt like the world was ending. So they waited for it to drop more. And instead, it ripped 50% higher by August. By the end of 2020, the market was at all-time highs again. The people who waited missed the entire recovery. They got their crash, and they still did not buy. That is how you end up holding cash for 5 years, 10 years, 20 years, and watching everyone else get rich while you sit there thinking you are the smart one. You are not the smart one. You are the one who let fear run your life. This pattern repeats every single cycle. After the dot-com crash in 2000 through 2002, the S&P dropped 49%. It took 5 years to recover to the old highs. But if you dollar cost averaged through that entire period, buying every month while it was falling and recovering, you came out massively ahead of the person who sold at the top and waited to get back in. Because that person never got back in. They watched it fall, they waited for it to fall more, then they watched it recover, and they waited for it to crash again. By the time they felt safe, it was 2007, and they bought right into the financial crisis. Same thing after 2008. The market dropped 57%. Housing collapsed, banks failed, Lehman went under. It felt like the end of capitalism. And the people who bought at the bottom in March 2009 were not the people who had been sitting in cash waiting. They were the people who were already invested and kept buying through the fear. The cash sitters waited until 2012, 2013, when it finally felt safe again. And by then, they had missed a 100% rally. The second worst performance was bad timing. But here's the thing, even bad timing beat cash by a mile. This person bought at the peaks, this person got it wrong over and over, and they still did fine because they were in the market. Being wrong and invested is better than being right and sitting out. Third place was dollar cost averaging. Spreading your dollars evenly across 12 months, it does not maximize returns, but it smooths out the volatility and it keeps you disciplined. It is a psychological win, even if it is not the mathematical optimum. The second place was lump sum investing. Putting all your money in on day one. The reason this beats dollar cost averaging on average is simple. The market goes up more often than it goes down. If you invest early, you capture more of the upside. If you spread it out, you're dollar cost averaging into higher prices on the way up. You only win with dollar cost averaging if the market is falling while you deploy. Since the market rises more than it falls, lump sum wins more often. First place was perfect timing, buying every single dip at the exact bottom. And yes, it outperformed, but not by as much as you think. The gap between perfect timing and lump sum investing was not life-changing. It was not 10x. It was not even 2x. It was a modest edge. What does this tell you? It tells you that the strategy you pick matters far less than whether you are invested at all. The difference between lump sum, dollar cost averaging, good timing, and bad timing is real, but it is small compared to the difference between any of those strategies and doing nothing. Your biggest risk is not bad timing. Your biggest risk is paralysis. Now, I know what you're thinking. You are thinking that is fine for historical averages, but what about today specifically? What about the risks I mentioned? What about the fact that Warren Buffett is sitting on a record cash pile? Let's talk about Berkshire Hathaway. Yes, they have more cash than they have ever had. Over $300 billion in cash and short-term treasuries as of the most recent quarter. That is a record. And people look at that and say, Buffett is selling, Buffett knows something, Buffett is preparing for a crash. I should do what Buffett is doing. Here is what they miss. Berkshire's total assets are over $1 trillion. $300 billion in cash and treasuries is less than 30% of the total portfolio. That means more than 70% is still in equities and operating businesses. If you look at a traditional 60-40 portfolio, 60% stocks, 40% bonds, Berkshire is more aggressive than that. They have more equity exposure than a standard balanced portfolio. So if you are sitting in 90% cash or 100% cash thinking you are following Buffett's playbook, you are not. You are doing something far more extreme than what he is actually doing. Buffett has not abandoned equities. He has trimmed, he has raised cash, but he is still overwhelmingly long risk assets. And here's the other piece. Berkshire's cash position is not just about market timing. It is about optionality. Buffett is not trying to call the top and get out before everyone else. He is building dry powder so that when something dislocates, when credit markets freeze, when forced sellers appear, he can deploy billions into opportunities that require scale and speed. He did this in 2008. He did this in 2020. He will do it again. But that is not market timing in the way retail thinks about it. That is strategic positioning for a firm that operates more like a sovereign wealth fund than a hedge fund. In September 2008, Buffett deployed $5 billion into Goldman Sachs in the form of preferred shares with warrants when the credit markets were frozen and nobody else could access capital. He got a 10% dividend and warrants that generated billions in profit. A month later, he put another $3 billion into General Electric on similar terms. In April 2020, he did not panic sell. He bought more of his existing positions and deployed into Verizon and Chevron. These were not market timing calls. These were opportunistic deployments when he had pricing power because the seller was desperate. You cannot replicate that as a retail investor. You do not have the phone numbers. You do not have the deal flow. You do not have the legal teams to structure preferred equity tranches. Buffett is not sitting in cash to time the market. He is sitting in cash to be the lender of last resort when the world is on fire. You are not Berkshire Hathaway. You do not have a $1 trillion balance sheet. You do not have the deal flow to deploy billions into private rescues of blue chip companies. Your opportunity set is different. Your time horizon is different. Your liquidity needs are different. Comparing your situation to Buffett's is like comparing your backyard garden to industrial agriculture. The principles overlap, but the execution does not. So what should you do? I'm not going to tell you to buy. I'm not going to tell you to sell. I do not know you. I do not know your risk tolerance. I do not know your time frame. This is not financial advice, but I will tell you what the data shows. The data shows that people who wait for crashes usually miss them. The data shows that buying at all-time highs has historically been a winning strategy over long periods. The data shows that the gap between good timing and bad timing is smaller than the gap between bad timing and no timing. The data shows that staying in cash is the most expensive decision you can make if your goal is to build wealth. Your brain is wired to keep you alive, not to make you rich. It is wired to avoid predators and find food and stay safe. That wiring does not translate to investing. In markets, the thing that feels safe, cash, is often the thing that destroys you. And the thing that feels dangerous, buying when prices are high, is often the thing that builds generational wealth. Does that mean you should go all in right now with zero regard for risk? No. Does that mean you should ignore valuation and blindly buy at any price? No. Does that mean crashes never happen and you should never think about downside protection? No. What it means is that if you're sitting on the sidelines because you're waiting for the perfect entry, you need to understand that the perfect entry almost never feels perfect when it arrives. It feels terrifying. It feels stupid. It feels like you're catching a falling knife. And by the time it feels safe, the move is over. The crash you're waiting for might not come, or it might come and you still will not buy because it will not feel like the bottom, or it might come and you will buy and it will drop another 20% and you will panic and sell at the real bottom. That is what actually happens to most people who think they are going to time the market. I'm not saying do not try to time it. I am saying understand the odds. Understand that even if you get the timing wrong, being invested with bad timing beats sitting out. Understand that the cost of waiting is often higher than the cost of being early. If you cannot sleep at night because you put everything in on day one, then dollar cost average. If you need to feel like you are being cautious, build in over 6 months or 12 months. That is fine. It is not optimal, but it is better than zero. The goal is not perfection. The goal is participation. And here is the last thing I will say. 5 years from now, 10 years from now, people are going to look back at February 2026, and they are going to say one of two things. They are either going to say, I am so glad I stayed invested, or they're going to say, I cannot believe I sat in cash for that long. There is no third option. In most plausible scenarios where the system survives, decades in cash have left people far behind those who owned productive assets. The only world in which that does not matter is one where the financial system itself is broken. For over a century, broad U.S. stock indices have repeatedly made new all-time highs, despite wars, crashes, and crises. History says that, over long periods, markets have tended to recover from crashes and push to new records. Although the wait can be many years, and there are no guarantees it will always work that way in every country or every decade. Every single all-time high in history looked like the top to someone. Every single one felt too high. Every single one had a reason to wait, and the people who bought anyway are the ones who built wealth. This is not hype. This is not cheerleading. This is not me telling you the market only goes up. The market will crash. It always does. Crashes have historically been temporary in broad U.S. markets, and long-term growth has been the norm, but not a promise. The long-term trend has been up, with painful, sometimes decade-long detours in between. And sitting out because you are scared of a drawdown is like refusing to get on an airplane because it might crash. Yes, it might. But the odds say you are far more likely to reach your destination safely than you are to die in a fireball. Do not let them shake you out. Do not let fear turn you into the person who watches from the sidelines while everyone else participates in the greatest wealth-building machine in history. Do not sell your future to feel safe today. Screenshot this video, save it. Come back to it in 6 months, come back to it in a year, and see if the thing you were afraid of actually mattered. See if the crash you were waiting for ever came. See if staying in cash made you richer or poorer. If this video changed the way you think about investing at highs, leave a comment. Tell me what clicked. Tell me what you disagree with. Share this with one person who is sitting in cash right now waiting for permission to get in. And subscribe if you want more breakdowns like this that cut through the noise and show you what the data actually says. Do not be the person who let fear steal your future. Be the person who understood the game and played it anyway.